Every single day, money rushes in and out of a modern business in a chaotic, multi-directional blur. Thousands of transactions hit a single bank account, overlapping and colliding. To make sense of this chaos, we're going to isolate it inside a highly controlled, closed system. Let's build a standalone coffee shop. When you look closely at the bank ledger for this shop, you run into a dangerous operational illusion. To an untrained eye, every single dollar leaving that checking account looks exactly the same. But if you treat a dollar spent on espresso beans the same way you treat a dollar spent buying the building, your numbers will lie to you. Accurate financial reporting demands a hard line between structural, long-term investments and day-to-day operational costs. Treating all cash flows identically distorts reality. If you fail to separate the structure from the operations, it is mathematically impossible to know if your business is generating wealth or quietly failing. To break that illusion, we have to look past the raw cash moving through the account and focus on where that financial data ultimately lands. There are two final destinations. The first is the balance sheet. This is your measurement tool for tracking the long-term structural health and the physical infrastructure of the business. The second destination is the income statement, or profit and loss. This tool is used exclusively to measure short-term operational profit, how much money the shop actually makes from day to day. This diagram shows a routing filter that separates the single, chaotic stream of cash into two distinct pipes, capital and revenue, sending each transaction to its correct destination. Building and understanding the logic behind this routing filter is the only way to accurately map a business's operational reality. To program that filter, we need a way to mathematically categorize every single transaction that occurs inside our coffee shop. We can plot this using a simple 2x2 matrix. The columns divide the cash flows by direction, expenditures for money going out, and receipts for money coming in. The rows divide them by nature, capital on the top and revenue on the bottom. Let's focus entirely on this top left quadrant, capital expenditure, or CapEx. This is money spent to acquire, upgrade, or maintain physical assets that will provide value to the business for longer than one accounting year. Along with that espresso machine, this includes the initial interior fit-out, renovations to the cafe seating area, and buying commercial-grade refrigerators. In accounting, we capitalize these assets on the balance sheet. Then, instead of taking the financial hit all at once, the cost is gradually expensed over the asset's useful life through depreciation. Capital expenditures allow you to build the structural engine of the business without immediately destroying your monthly profit margins. Once that structural engine is built, you actually have to run it. This brings us down to revenue expenditure, or OPEX. These are operational costs consumed within a single accounting period. They maintain earning capacity, but they do not extend the life of an asset. Think of your daily consumable inventory: coffee beans, milk, flavored syrups, and pastry stock. It also covers ongoing operational costs: paying your barista wages, the store manager's salary, monthly rent for the premises, and routine maintenance like replacing the group head seals on the espresso machine. These costs are expensed immediately on the income statement for the exact period they are incurred, directly reducing your net profit. OPEX represents the raw fuel required to maintain current operations. It is completely distinct from long-term asset building. Now we flip the model. We are done looking at money leaving the business and are turning our attention to the money entering it. We start in quadrant 3, capital receipts. This is income generated from non-operating activities. It usually takes the form of structural financing. For our coffee shop, this looks like securing a £50,000 small business loan from a bank to open a second location. When that £50,000 hits the bank account, it creates an immediate liability for the business. Every cent of that money must eventually be paid back. Other examples include the owner injecting personal savings into the company in exchange for equity, or selling off an old, fully depreciated display fridge to a competitor. Because these funds are tied to long-term structure and financing, they are recorded directly on the balance sheet. These are massive cash inflows, but because they are structural, they completely bypass the income statement. This prevents a giant bank loan from artificially inflating your day-to-day profit calculations. The final quadrant captures the income generated through the shop's primary commercial activities. revenue receipts represent income generated strictly from normal day-to-day trading operations. For the shop, this is the recurring daily sales of flat whites, lattes, and baked goods directly to your customers. It also captures secondary operational income, like selling bags of retail coffee beans off the shelf, or generating cash from catering a local office event. In the ledger, this is recorded as top-line revenue, or sales, right at the top of the income statement. Unlike the non-recurring one-off financing of CAPO receipts, revenue receipts are steady, operational, and recurring. This quadrant is the ultimate metric. It tells you whether your core business model actually works in the open market. With all 4 quadrants populated, we can step back and look at the taxonomy framework as a whole. This maps transactions by nature, timeframe, and destination. Watch them interact. A capital receipt £50,000 loan funds a capital expenditure espresso machine. That machine processes revenue expenditure beans and milk to generate a revenue receipt flat white sale, feeding cash back into the system. It is a symbiotic relationship. Capital flows build the structural engine, while revenue flows serve as the fuel and the exhaust of that engine running day to day. If an entrepreneur treats all of these cash flows identically in the ledger, they are flying blind. If you miscategorize an expensive capital expenditure as an immediate operational cost, a highly profitable business will look like it is bleeding cash on paper. Conversely, if you record a massive bank loan as daily revenue, you create a dangerous, false illusion of operational success. The goal of accurate financial routing is to maintain a pristine mental model of reality. You need your balance sheet to accurately track your long-term infrastructure and obligations, so your income statement can reflect your true operational efficiency. Mastering this distinction provides the structural logic required for a business to survive.